Recently, famed real estate investor and entrepreneur Ryan Pineda made a statement that stoked a ton of fear and anger about the real estate market. On a recent episode of the Iced Coffee Hour podcast hosted by Graham Stephan, Ryan said that the real estate market isn't likely to crash in the same way it did in 2008. By now, we're fully aware that the 2008 housing crash was caused by banks being over-leveraged in subprime mortgages that had been cleverly disguised as well-diversified loans. These loans were bought up by the banks, and an enormous amount of people began to default on their adjustable rate mortgages. The banks eventually began to collapse as well, triggering the entire global market to crash and creating a historic recession. But that's not what's happening right now. Instead, Ryan says, we're seeing large hedge funds scooping up houses on the market faster than we can build new ones. These homes, which were once available for normal people to buy and sell, are now beginning to land more and more in the hands of these giant funds, where they are unlikely to ever get put back on the regular market. This practice is creating an artificial shortage of houses available, which continues to cause prices to skyrocket. Worse yet, oftentimes these large funds are hiding the true nature of their status as multi-million-dollar corporations. Through clever marketing, they are making it seem as if they're just small mom-and-pop investors instead of the hedges they really are, so that people don't feel hesitant to sell to them. Now, while Ryan isn't the first person to make these type of statements, he is the first person to have an insider's perspective as funds have reached out to him and tried to partner with him on some of these type of investments. Now, this is obviously a very concerning practice, but what's important to keep in mind is this type of behavior can't last forever. After all, if this really is making them that much money, then other corporations are going to jump on board wanting to make profits as well. And yes, more competition will lead to higher prices, but eventually those margins of profit because of the high prices will start to dwindle. After all, if there are all these corporations holding all these houses and they're trying to rent them out, that's going to create more competition for finding renters, which is going to cause the price of rent to go down. As the price of rent goes down, it won't justify their initial investment, which means that these houses will have to eventually be sold off. And as these corporations start to see a higher risk for holding all these homes, they'll start to not to want to buy them from one another as much, which will allow them to be opened up to the public market. Right now isn't the best time for it to be open on the public market anyways, with the interest rates continuing to increase. But it's important to remember our tendency as a nation has always been towards lower rates in order to promote spending and growth. Times like now, where the Fed is raising rates by a factor of 50 basis points a month, are the exception, not the rule. I mean, think about it for a second. If you can't afford the house because of the taxes, how can a corporation? I mean, yeah, they have a lot of money, but they only make that money by passing on the cost to the consumer. In this case, the consumer is anyone who's renting the houses from the corporations. Remember that the price of the rent is always going to be higher than the price of the taxes because they have to be able to make a profit on what they're paying in taxes. But if the average consumer can't even afford the taxes, how are they going to afford to pay the much higher rent? And if no one can afford to pay rent in those houses, then how are they going to make a profit if there's no one to rent them out to? This would cause the corporations to have to sell those houses and cause a flood of houses joining the market again, which caused the housing market to crash. And once again, that crash would cause housing prices to lower, making them more affordable for the average person without the need of higher interest rates to curb the price of houses. This is the simple law of supply and demand. Remember that the market always self-corrects, and nothing maintains that aggressive growth forever. Except, of course, Bitcoin. Just kidding. But as always, guys, remember that these are just my thoughts. I want to hear your opinion as well. And if you have any questions about real estate or financial growth, feel free to reach out to me by commenting down below. And if you live in the state of South Carolina and are interested in buying or selling homes, feel free to reach out to me by going to askjeremysc.com. That's SC as in South Carolina. Thanks, guys. Have a great week.